Well, hello and a very warm welcome to this Scope Group webinar, Caveats and Pitfalls in Stress Testing Banks for Climate Risk. My name's Keith Mullin. It's my pleasure to be moderating today's session. I'm absolutely delighted to be joined today by Sam Theodore, a senior Scope Group consultant. Now, in a moment, I'll hand over to Sam, who will make some comments about some of the challenges of climate stress tests for banks. And after that, we'll be more than happy to take and hopefully answer some of your questions. There is a questions box available on the platform, so please type them in as we go along. Now, of course, we're hosting this session during the COP26 summit. So combating climate change has been under intense scrutiny. And central banks and supervisors have indeed taken some positive steps around climate stress testing, but this process, as Sam will go on to explain in a moment, is not without its challenges. So I'm very much looking forward to hear what Sam has to say. So without further ado, Sam, it's great to see you. The floor is yours.
Thanks, Keith. Hello, everybody. I think we all agree that following the great financial crisis, stress tests have become a very powerful supervisory tool, and all supervisors are running stress tests for the banks they supervise every year, every other year, with, in general, positive results. And the call it science of stress testing has improved, has become more reliable. I was personally involved in one of the first stress tests done by the EBA 10 years ago on European banks right after the GFC, and I remember that one not being one of the best stress test exercises, but in the meantime, everything much improved. Now, then the question arises, is everything which represents risks for banks stress testable? Can we stress test social upheavals? Can we stress test wars? And the answer is probably no, but then the question is, can we stress test climate change? Because the science of climate change is still at its beginnings, and the amount of data and the metrics are still not fully reliable, not to the extent that they could represent something based on which banks should pursue their activities over several decades ahead. Nevertheless, supervisors chose to do these stress tests, also pushed to some extent by public opinion, by political forces, by the need, as Keith mentioned, by the need of all of us to do something for climate change. And I think one of the first by the way, Europe in this context is far ahead compared to the rest of the world. I believe Brazil is also advanced to some extent, but as far as I know, the rest of the world is far behind Europe in terms of pushing climate risk to the forefront of banks' activities and risks. The Dutch Central Bank in 2018 undertook an exercise to look at the impact of climate change on banks and insurance companies. Earlier this year, the French regulator published the results of its stress test exercise on French banks, which was very positive. Another exercise is underway in the UK, and we'll probably see the results at some point in the near future. And 2 months ago, the ECB, not the supervision area of the ECB, but the ECB, the central bank, published the results of its economy-wide stress test, which I thought was a very interesting report, very well documented, very much in depth, covering data from more than 4 million business counterparties in Europe and around the world, and the loan and investment portfolios of 1,600 banks in the euro area. And I'll get very briefly over some of the conclusions of these reports. Now, I mentioned earlier Europe is ahead of the rest of the world. If we look at the US, they are nowhere near the level of Europe in terms of linking banks with climate risk. 2 months ago, there was a methodology, a proposed methodology published by the New York Fed on how to stress test climate risk for banks, for US banks. The exercise is focused solely on transition risk, excluding physical risk, which to me is a positive. I'll get to that in a few minutes. And then it just looks at the largest bank. So it's another difference from the ECB, and perhaps a conclusion to draw from that. Maybe there's no need to look at 1,600 banks, because as I'll mention here later, the bulk of the pollution, the bulk of the carbon content of the aggregate sector's balance sheet is with the large banks, especially those with large corporate exposures. So I mentioned again that next year, between March and July, the supervision area of the ECB will perform the climate stress test, which hopefully will be in depth and very positive, but which they themselves said won't have any prudential consequences. So in other words, it won't result, the results of that stress test won't result in any capital charges or changes in capital requirements. And I think that's a very positive, statement, because at this stage, the science of stress testing on climate is not very advanced, and any results would not be very credible. Now, in terms of the some of the findings, conclusions of this ECB economy-wide stress test, which I mentioned, and by the way, SCOPE published some reports in the wide-angle series that I author on linking climate risk with stress with banks. Some of the conclusions are that one, the main risk, climate-related risk for the sector, for the banking sector in Europe, long term, is related to physical risk, not to transition risk. And physical risks have been identified mainly in the form of wildfires in Southern Europe, and to a somewhat lesser extent, floodings and an increasing the sea level in Northern Europe. And one of the takeaways of that stress test is that the more banks address transition risk in the short term, the more they protect themselves against physical risk in the long term. The ECB uses 3 scenarios, which will also be used in next year's bank stress test. The first one is that of an orderly transition. The second one is that which they call the hothouse scenario, which is basically no transition. And there's a third one in between, a disorderly transition scenario, where transition is undertaken but late and not in an organized fashion. So again, the conclusion is that the more banks are focused today on transition, the less they will be bothered by physical risk later on. Another takeaway from this stress test exercise is that the large non-financial corporates represent some 50% of the average corporate loan exposure for these banks, but 90% of the pollution, of the carbon content of these portfolios. And also there's a large bank bias, so 80% of the total carbon exposure of these business loans is in the balance sheet of the significantly important banks across the euro area. Now, this to some extent jives with another report done by the European Systemic Risk Board, this time for all EU banks, not only the Eurozone banks, which earlier this year noticed that the top 25 banks in the EU hold some 70% of the corporate exposures, large corporate exposures with high emissions. So to some extent, we can talk about climate risk being a universal problem for all banks, but in practical terms, if you want to address it, yes, you can look at each small bank and look at the carbon content of its balance sheet and draw the conclusions. But in practical terms, if you address it with a large exposures to high emitting companies coming from the large banks, you basically address 70-80% of the climate change challenge for the banking sector. That's something to bear in mind, because in my mind, you don't need to have the perfect TCFD disclosure of scope 3 emissions for all of your counterparties and to have the perfect comprehensive transparency in the carbon content of your balance sheet to be able to start addressing some of these climate challenges by managing your exposure to the large corporate polluters like fossil fuel companies, transportation, and other economic sectors. So let me go now over some of the caveats and pitfalls of the stress test method as they transpire from this ECB stress test, because I think it's important to bear in mind that if we see this exercise and we read its conclusions, and if its conclusions say, well, banks are well on their way to address climate risk, we shouldn't be reassured. There are some important uncertainties which I'm not sure that a stress test on climate risk can address easily. The first one is that of projections through 2050. So basically 2050 is the timeline set up by COP21 in Paris, reaffirmed by COP26 now in Glasgow, when countries commit their economies will get to net zero. Fine. Now, as far as I'm concerned, this would be the first time in history that banks are expected or expect themselves to make projections and loss estimates going over almost 3 decades. This is practically impossible, and it's really not very credible. As far as I'm concerned, I doubt that anybody signing off these projections and estimates today will be in a management position, in a decision-making position, not 30 years from now, but even 10 years from now, when some of these banks say we have our the content of the carbon content of our balance sheets. So that should be taken with a grain of salt, these 30-year projections, which would be one of the conclusions, inputs and conclusions of these stress tests. Another one is, in my mind, the unsuitability of the static balance sheet approach. Now, in the early stages of stress tests, supervisors chose a static balance sheet approach because it was more reliable than the dynamic balance sheet approach, meaning we need to include management action. So if a severe economic scenario led to increased asset quality for banks, the assumption is you are not going to do anything to address this worsening asset quality, just see how the balance sheet performs under stress. More recently changed, the dynamic balance sheet approach is being adopted, especially by the Bank of England, which I think is very positive. The ECB economy-wide stress test from last September uses a static balance sheet approach, which is clearly very unrealistic, at least in my mind, over a 30-year period. You have to assume that banks will do nothing over 30 years if they see a climate risk aggregating in their balance sheet. As far as I understand, next year's bank stress test will have a dynamic balance sheet approach, which is fine. But the question in my mind is that what sort of management action can you expect in a climate risk stress? So how can you know, and how can managers know how they're going to react, say 10 years from now, 15 years from now, even 5 years from now, to some unexpected weather events, extreme weather events, or massive disruptive transition in the climate field or environmental field, like change regulations, like breakthrough technologies and things like that. So I think that the way the stress test is going to be done raises some significant question marks. Another caveat is that of what I think, and I mentioned that, the plausibility of the scenario. So it's very difficult to build at this stage plausible scenarios for the next 30 years in a field which is still very uncertain. I mean, I'm very skeptical of models which can anticipate climate developments, especially in physical risks, over decades ahead and even years ahead. So I have reason to believe that these scenarios will change a lot as time goes by. Another major caveat is that of the interaction between transition and physical risk. So again, the ECB economy-wide stress test tried to establish this sort of interaction. As I mentioned, the conclusion is more transition risk today is positive because that means less physical risk tomorrow. But even in an orderly transition scenario, the perfect scenario of banks responding to all the changes, technology and regulatory changes with respect to climate, one cannot assume that you're not going to have that this will eliminate physical risk for the future. You are going to have extreme weather events as you had them in the past, even before the industrial age, during the early stages of the industrial age. So it's very difficult to make a correct interaction between transition and physical risk, especially to the level of including them in a bank stress test. And that remains to be seen how this is going to be managed in the future. In general, as another caveat, when supervisors and market participants and banks rely too much on models to anticipate and manage the future, the results can be disastrous. And we have to remember the sad fate of Basel II, the early stage, the intermediary stage of Basel, which sort of blindsided the market when the great financial crisis started. Everybody felt banks are well protected by a strong regulatory framework, and the models would sort of anticipate losses, and all these things didn't happen, and banks suffered what they suffered during the GFC. And the last, probably most important caveat for me is this one. Now, the purpose of the stress test is to see how the bank's capital and liquidity will perform in an extreme scenario, and thus to anticipate future losses. So banks have to undertake climate risk management today to stave off, to prevent future losses, which makes sense. That's what banks would be expected to do. But the primary reason for banks to engage in climate risk management and to push a change in their lending policies towards corporate polluters is not only to minimize future losses, but because this is the right thing to do today, not tomorrow, for the planet, for future generations, for the current generation, and for themselves. So this is clearly not being part of a stress test. So if the result of a stress test for a bank would say, well, whatever you do, don't worry, climate risk is not a risk for you, you don't need to worry about climate change. Well, the bank should worry about climate change, even if the expected losses in 2050 based on this stress test are not going to look disastrous. So that to me is something which both the banks and investors in banks have to bear in mind when they look at the impact of climate risk on banks' balance sheet and revenues. So again, the parting point for me is whatever they do, the supervisors should avoid, and right now that's what the plan is, imposing capital charges based on climate risk, as long as the science of climate risk for banks is not yet up to speed, which is the case currently. So maybe in the future things will change, but I think that it's good to bear in mind some of these caveats when we look at how the structuring of climate risk for banks' balance sheet comes about in the future. These were my brief remarks, and thanks, Kit. Now it's up to you to follow up.
Very good. Thank you very much for those comments, Sam. So let's move now to questions. Please feel free to type your question into the questions box, and let's see if we can put them to Sam. But Sam, while we wait for questions to come in, one thing I'll put to you, this is perhaps an overarching question. You brought up caveats. You brought up the fact that this is the whole area of climate science and climate risk management, and supervision is at a very early stage. And the data availability is just, we just don't have standard data available. Bearing in mind we're looking at 2050 projections, yet people want action today. How do you think investors should be approaching this subject when they look at investing in banks?
Well, I don't think that investors actually, investors talk a lot about climate change and about sustainability, all these things, which is very positive. But each time I listen to presentations by banks during the results seasons, pretty much nobody is asking questions regarding ESG in general and climate change in particular. And you cannot say because investors don't care, that's not the case, and we have proof that's not the case. But it's simply the fact that, in my opinion, you cannot price climate risk today in banks' equity prices and in spreads on funding. And if that's the case, there's no added value for the analysts and for the investors to look at this climate change, and to try to look at relative value, including ESG factors, in especially climate change. Hopefully that's going to change in the future, but it's not the case right now. And I think that what's really worth mentioning is that concept of impact investment. So in the past, you had the risk-return relationship, to which now you have to add the impact element. So you have risk, return, impact. So if that's the case, even if you don't see a precise conclusion in your risk-return equation of, for example, the bank doing the right thing in terms of climate or social impact and things like that, nevertheless, the bank should be more investable if it does the right thing, which is not always, again, accompanied by a financial metric. So that to me is more it's beyond the judgment call. It's a matter of changing philosophy in investment. I think it's coming very slowly. At this stage, is mostly at the level of senior management in these asset managers and investment firms. But as it trickles down to portfolio managers and to buy-side analysts, I think maybe in a few quarters, we'll start hearing more questions about climate risk in these bank results presentations.
Indeed, and the other, absolutely, Sam. The other aspect of this, and you mentioned the fact that we're moving from a kind of a voluntary regime, whether it's TCFD and other metrics, green bond principle, it's all voluntary. And a lot of the attention is to drive transition. And we're moving to a world of voluntary disclosure, etc., and maintaining voluntary standards to a sort of regulatory hardwired world. Do you see any kind of gap risk between the voluntary world and the regulated world when we know so little about some of these risks and a lack of modelability?
Well, I think it's a normal road. I think that eventually it will be there. I mean, all regulators in Europe said clearly, non-financial disclosure, it's mandatory. It's going to be mandatory. So I think we're waiting for that to happen. And the EBA, as I understand, has a leading role in that, and they'll come out with some steps and proposals earlier than assumed. Initially, they wanted to come out in 2025, and now the ECB says, the European Commission says, no, you have to come out earlier than that. So 2023 would be the year when they'll come up with some conclusions. So definitely you'll see more regulatory disclosure on non-financial elements. Climate risk is one of them, but hopefully it's going to be more on environmental risk in general, and then social elements later on. I think the more disclosure you have, the more transparency you have, the better off the investor is when looking at the bank. On the other hand, I strongly feel that you don't need to have the perfect disclosure. You don't need to have the comprehensive approach on what's the carbon composition of your entire portfolio, all the way to scope 3. You can start taking steps today because your largest exposure to corporate polluters. You know what they are. You know how to manage that. You don't need to wait for the 2030 or 2050 to do something about that. Yeah. So I think action before full disclosure would be very positive.
Absolutely. So Sam, when you were thinking about these pitfalls and challenges to all of this, and given your background as a regulator, as a credit analyst, what were some of the key issues that were coming into your mind about about how this process moves forward? What are the real standout challenges that you think are going to cause some it'll be hard to surmount?
Well, I think that first of all, it's the science of it's nice to say we have to have more disclosure on climate risk. The TCFD came with all this disclosure framework, which I think is very positive, and you have the scenarios proposed by the network of central banks for greening the finance, and all these things exist already, and you have the proposed course of action of the recently created Glasgow Alliance, Financial Alliance for Net Zero. So all these things will happen, but probably too slowly. Again, my point is that you don't need to wait until you have the perfect disclosure to start taking some immediate action on large exposures to high emission corporate counterparties. If you do that, you can address 70-80% of your climate change challenge even before having the comprehensive perfect disclosure sometimes in the future. Again, the focus should be mostly on action, not so much of improving disclosure. It's good to improve disclosure, but right now, when you talk to investors about banks and climate risk, the main point they raise is, well, the banks have to improve the disclosure. No, I think what the banks have to do, because they have enough disclosure for the main corporate borrowers which are polluting the atmosphere, the main thing that they have to do is to start action with respect to these exposures.
Yeah, absolutely. Sam, there's a couple of questions that have now just come in. If I may, I'll just read them out to you. I'm not sure if you've had a look at them yet, but one is a real kind of, it's a question about outputs, which is under the stress tests. Will we see banks ranked from those most ahead on the transition path to those that are slowest? And part B to that is there agreement between different European jurisdictions about how to measure this transition path?
No, I don't think so. I hope, I'm not sure, but reading the methodology that the ECB proposes, I don't think they're going to start ranking banks. Clearly, they're not going to, I mean, the way they do the traditional stress test when you see, well, banks like MPS are at the bottom of the, no, we are not going to see that on climate risk. I hope so, because it would be highly, highly disruptive if they did that, but I'm pretty sure they are not going to do that. So in the first stage, you're not going to have that. You're not going to have negatives to say these banks are very negative and we have to put them under observation. In terms of authorities cooperate among themselves. The EBA coordinates the national competent authorities, but I think what the world is still missing right now is a credible extreme scenario for climate change with respect to banks. And what the ECB has done, and I think it's the first time this has been done, is to create this scenario, and they are going to build up on this set of scenarios next year with the bank stress test. And if that's the case, if that's going to be adopted, at the end of the day, you have the same climate challenges, whether you are in Europe, in the US, maybe with these different extreme weather events, but still the challenge for the banks is pretty much the same.
Yes, indeed. And there's another question here, which again, I think is quite a pertinent question, which is this: are you at all concerned by the fact that it seems authorities are looking to the banking sector as the main means of transmission of behavioral changes that might more appropriately be taken by elected policymakers through dialogue with the populations that they govern?
Well, I think, I mean, I'm not sure about that, but I think in general, the banks should not be made the scapegoats for, not being up to speed on climate change, because at the end of the day, banks are only enablers through their financing. So it's not the banks which pollute the atmosphere. It's not the banks which release, greenhouse gases in the atmosphere. It's the different industries like energy companies, transportation, agriculture. It's not the banks themselves. So I think that it's very important that banks and financial institutions in general should be focusing on climate risk, and nobody disputes that. But it's not the bank's behavior which is going to change the climate environment in the world anytime soon. Again, banks are just enablers. They are not the main culprits in polluting the atmosphere.
Indeed. Just on that, perhaps a follow-up from me. If banks are enablers, how easy is it for a large bank to become a disenabler?
Well, I'm not the bank CEO.
No.
But I'm not sure. I think that banks, when they say, well, it's not easy, I don't think it's that difficult. Again, you're not talking about 100% change in your approach. You're talking about, and I would make a difference between retail and corporate banks, because retail banks, take the example of Lloyd's, La Banque Postale in France, or others, they have mostly a retail portfolio. It's easier for a retail bank to say we are going to lower the carbon content of our balance sheet. But when you're a corporate bank and have some significant relationship with some large traditional energy companies, for example, take BNP and Total, well, it's more difficult to readjust, but it's not impossible. So if you start working today, not in 2025 or 2030, today, with your large corporate borrowers which are polluting, you can have some impact on them sooner rather than later, through a dialogue, through a restructuring of the portfolio, through repricing the loans. For example, you have a large energy company which is engaged in fossil fuels, but also in green energy. You can price loans to the different divisions of this large energy company in different ways. And I understand that's something which has been happening with Shell recently with some of its banks. So there are measures which can be taken even before, again, you have this full disclosure that everybody's looking for.
Yeah, indeed, makes sense. So if there are any more questions, please do type them in. We'll finish in a couple of minutes if there are no further questions. But Sam, did you want to make any kind of closing, just a brief closing statement about where we go from here with all of this?
No, I think that, again, the closing is, I'll be very interesting, like a lot of us, to see what the results of the stress test will be next year coming from the ECB, and then to see where the banks go from there. But again, my point is that you don't need to wait for the stress test. You don't need to wait for the perfect disclosure. Start acting now. And as investors, because here you're talking mostly to investors, not to the banks themselves, start looking at how banks are doing on the climate front, even without having the perfect disclosure in front of your eyes.
Yeah, very good, absolutely. Before we close, actually, I did just want to make a brief comment about Scope Group's climate stress test. This is a product/model that allows financial institutions to check their portfolios on existing carbon intensities and related long-term physical and transition risks, which are aligned, as Sam mentioned, with the ECB's orderly, disorderly, and hothouse world scenarios. Now, the scenarios in the Scope climate stress test model employ different assumptions for carbon price policies: higher in the short term in the orderly scenario, low but rising strongly over time in the disorderly scenario, and remaining low in the hothouse scenario. Now, what's the outcome? Well, the outcome of the stress test is the long-term deviation of corporate revenues from the orderly baseline scenario, and a distinction between direct revenue impacts from climate stress and indirect impacts through supply chain exposure. And these model outcomes can be aggregated on a portfolio level and compared to sectoral averages. There should be just below the bottom of the screen a downloadable file, a short PDF. So if you want to find out more about Scope's climate stress test, please do click on the on that download. And of course, as ever, if you need any more information, do come to us and we will help you as appropriate. So Sam, as there are no more questions and I've finished my announcement, my statement, I suggest we close. So thank you very much for preparing those incredibly, thoughtful comments about, I guess, a critical subject that is going to be with us for the foreseeable future and beyond. Thank you to you for listening in and your attention, and thanks for the questions. Scope does a lot of these sessions now as complements to research, as a factor of investor outreach. So we'll be back soon, I'm sure, with Sam and indeed with others in the Scope complex. So that's it from me. Thanks for watching, and goodbye for now.